how to track your portfolio of shares. Once you have identified your portfolio of investments, what should you do as an investor? Well, do anything but sleep over it. The current environment of business is so volatile that you have to keep a continuous watch on the businesses. Let's try to understand a few points on how to track your portfolio. Point number 1 is creating a portfolio tracker. You should create a portfolio of your holdings on any tracker app. These days, a lot of brokers and investment sites provide you with the features of creating your investment portfolio. This provides you with a detailed update on your holdings, but also provides you with news, announcements from the company, financial numbers, etc. You can find such a tracker on the small case portal as well. Point number 2 is keeping a track on the market trends. You should always keep a track on the financial news related to your stocks especially. The idea here is to identify the big trend and to make changes in our portfolio accordingly. For example, with the recent India-China tussle, the government of India is putting anti-dumping duty on a lot of products from China. So, to take benefit from these changes, we have started to buy a lot of pharma and chemical companies which are going to benefit from this import substitution claim. Point number 3 is to read the annual report on a regular basis. An annual report tells you a lot of information about the stock. You can get a lot of information by reading the president's letter and management discussion and analysis section in particular. And you can also get to understand a lot about the company reading between the lines. Point number 4 is checking the quarterly results of the companies. We should keep a continuous track on the quarterly results of the company. And we should also track the conference call and investor presentation from the company every quarter. Point number 5, finding more information about this company from other sources. You can Google about the company, you can read newspapers, you can read research reports. You can also go to discussion forums on various platforms to understand more information about the company. Believe me, this gives you a lot of insight on the company's performance and its future. Point number 6 is interacting with the company's stakeholders to get a lot of information. You can talk to the customers, competitors, dealers to get a lot of insights on company's products, pricing, quality, pain points, etc. Remember, money saved is money earned. Today, we are going to talk about certain investment disciplines. To be a disciplined investor, you need to form some good habits and follow them consistently over the period of your investment. In our investment horizon, we see a lot of investors who at the time of committing capital say that they are long-term investors and they want to invest for say 2 to 3 years. But when they see a 5 to 10% fall in the markets, they start calling us and they start getting nervous. Rightly said by Mr. Warren Buffett, stock market is a tool to transfer money from an impatient investor to a patient investor. Let us now try to understand some discipline-related mistakes. Number 1, emotions. We see a lot of people having emotional bias over their judgment. In the world of investing, emotions can be suicidal. You can like a stock, but you should never love a stock. Those with disciplined investing make the most of all market cycles because they are focused to make profits and are not emotionally driven. Point number 2, change in allocation because of change in market sentiments. If you have committed your capital for a long term, say 5 years or 10 years, you should not change your allocation policy because of short-term sentiment changes. Believe us, you cannot foresee the market trends. Foreseeing the market trends is for fools and liars. In the long run, the short-term news and events do not affect the market, and the share price reflects the true valuations. Point number 3, blindly following tips from friends and family, WhatsApp forwards, TV analysts, etc. This is the most undisciplined way of investing. This can really backfire. Do your own research or consult a professional before investing. Number 4, not monitoring your investments. Many early investors in stocks like Unitech, Kingfisher, JP lost a lot of money as they never tracked their investments and kept a hold on their investments. You should continuously track your investments. You should continuously try to find out the weakness indicators in your investments. You should also look at the materiality of those weakness indicators. For example, in a 100 crores balance sheet, say you find a 1 lakh rupees contingent liability, even if the chances of paying that contingent liability is high, that might not be considered as material. Whereas, if that 1 lakh rupees is for a personal expenditure of the promoter, that can raise a red flag as it is a personal expenditure done on a public limited company balance sheet. What if you encounter a possible weakness indicator in your stock? Well, you should first try to find counter evidences for that weakness indicator. Say for example, a decline in operating profit margin of a company. Well, the decline in operating profit margin might be because of the reason that the company did a major expansion in the previous quarters and the capacity expansion will come into utilization in the subsequent quarters. You should keep on looking for such weakness indicators and the counter evidences. You can find a lot of such weakness indicators in the annual reports. Say for example, R&D section in the director's report. If the company is not spending on R&D, the company might not be able to grow in the future. You can find details about R&D spend, technology spend, and what the management thinks about it in this section. Let's take for example, a US-based company into watches called Timex Group, which was not able to envisage the future developments and was not able to make changes into its product and business lines. The company did not succeed and is still trading at the prices at which it was trading 20 years ago. In the similar time, a similar company called Titan Watches diversified into new products like eyewear, other retail products, etc. Now, the company has made a multi-bagger return for the investors because of this diversification and new product innovation. You can look at education and past experience of the management to understand the caliber of the management. An unprofessional and uneducated management could be avoided. Management remuneration of the directors gives critical indications. Very high managerial remuneration should be avoided as it might be considered as against the small shareholders. Financial statements has a section of related party transactions. Here you get information about related companies and the transactions between the listed entity and these related companies. A company with maligned intention might want to transfer profits from a listed entity to an unlisted entity or a privately held entity. As a matter of fact, we avoid those companies where the promoters of a listed entity are running a separate closely held company in a similar business. This is clearly conflict of interest. Financial statements also has a section of contingent liabilities. You should also look at the materiality of that contingent liability. Say for example, a company has won a case in High Court for a tax demand. However, the income tax department prefers Supreme Court. Now, considering that High Court is a senior judicial authority and it would have already considered all the significant material facts of the case, we can consider the materiality as low. You can also do some analytics like debtors went up by 50%, whereas the sales was flat. The company had spent a lot on legal expenditure, whereas there was no apparent reason. The company has been spending a lot on R&D, whereas there was no significant product launches. The prices of key raw material was down, whereas the operating margin of the company did not improve or was down. The company A and B are both selling similar products, but company A is having a margin of 30%, whereas company B is having a margin of 20%. Now let us take some real life examples. Example of Jet Airways. In 2006, the promoter Naresh Goyal went on to buy Sahara Airlines for $500 million. Little did he hear to advice from various analysts that the deal was too costly. He went on and bought that deal for all cash, taking a high debt on its balance sheet. Now, post the acquisition, the low-cost airline was renamed as Jetline. Now, the company wanted to operate both the budget airlines as well as a full-service airlines. The irony was, to manage both the counterparts, there was only one management team, and that too headed by Goel. Experts say that both the operations should have been separately handled by different managements. Jet Airways also underestimated the competition from the trio SpiceJet, Go Air and Indigo, where the trio was offering budget fares and was also serving the unserved routes. So Jet was not seeking any debt reduction, profitability was not stable, mostly the company was in losses, and the competition was killing its market share. An investigation of fraud is also underway on the erstwhile promoters. So, what we learn from this overall company fiasco is that you should not only look at tall promises from the promoters. You should also look into actions, and the actions should be reflected in the balance sheet of the company. Now, let us take another example. Videocon Industries. 10 years back, Videocon Industries was a market leader in most of the home appliances. They were acquiring a lot of marquee brands from many MNC companies. Now, in the process, they did a lot of unrelated diversifications, which resulted in a lot of debt acquisition, plus their margins were shrinking. In the process, they did a lot of unrelated diversification. Their debt was increasing, their margins were shrinking, their mobile business got shut, their oil and gas business was not providing sufficient revenues, and investigation of fraud is underway on the promoters. Now, all these symptoms were very much evident over the years. But in tall promises and the euphoria, investors chose to ignore them, resulting in wealth erosion for them. Basis our past experience, we believe that investors should not buy potential turnaround stories, but rather buy actual turnaround stories. I thank you for going through the small case modules. I hope that we were able to bring some positive ideas for your investment, and that you will be able to identify some good quality stocks available at great valuations and be able to make a great profit from those investments. Happy investing.